As business owners, sometimes, you come across opportunities and maybe you don't have the cash really to buy that property or that building that you wanted to buy at that time, because, typically at conventional, we require you 20 or 25%. Then boom, then you can use SBA.
I've always liked it because it allows us to do a couple things that bankers aren't known for, and that's being creative and flexible. So always try and keep one foot in SBA lending.
Less stress, more time, more money. Welcome to the Cashflow Contractor. Interview.
Martin, I have traveled probably more miles with one of our guests today than I have traveled with anybody else in my life, even my parents. I've got some great stories with Gonzo Garzon, who's joining us, but probably one of my favorite ones that I'll tell really fast is we're on a tight budget. We're running this new startup that we started out of college together, and we needed to get to Thailand, specifically Chiang Mai, Thailand. And so we found the cheapest flights possible. We booked flights on Delta from OKC to Los Angeles through Utah. Then we booked a flight on a China Airlines or something like that from Los Angeles to Shanghai, China. And then we booked a flight from Shanghai, China to Bangkok. And then we had a flight from Bangkok to Chiang Mai. I think it was like 48 hours straight of travel. And I just remember being in the airport in Shanghai on a layover, and it was probably one of the grossest places I've ever been. Oh. They just didn't take care of it. They're smoking cigarettes in the airport like crazy, and there's just like sirens going off, and Gonzo's trying to sleep on this plastic bench, and I just imprinted on my brain. But a lot of fun times. I don't think we're talking about any travels later on in this episode, but just a good little story. And
it was probably really 72 hours because you crossed the international date line, right?
That's true. We were in another day.
So you gained that 24 hours.
Fun memories, Khalil.
We did. Yeah, a lot of fun memories. Let's introduce our guests. So we got Gonzo Garzon, and then we've got Cashin White, both at BOK Financial, operating in 10 different states. But I'll let you guys kind of talk about what you do and what your role is inside of BOK Financials. So Gonzo, why don't you start?
Yeah, well, first of all, thank you guys for having us. I've been listening to you guys for a little while, and, obviously you and I have a relationship, and I've enjoyed kind of meeting you guys more. So I appreciate the opportunity. A little bit about myself. A little background. I was born and raised in Chile. I came here to the United States through tennis scholarship, and I've went through finance, and I loved the field. And then I got the opportunity to join BOK Financial. It was like early 2016. I was recruited to the credit commercial training program that BOK has here, and I've been a commercial banker ever since. So I primarily focus in the Oklahoma City market area. I also do SBA lending, and I know that's a conversation we're having today. But that's what I do. I enjoy working with entrepreneurs, business owners, and learning from them and just helping them grow. I'm primarily the main point of contact for business owners that have the relationship at BOK. So,
Is that point of contact for the whole 10 state area, or is that you talking just Oklahoma?
So we have several bankers in each location, states. So I primarily focus in Oklahoma City, and at any business that's located in Oklahoma City, we have all the bankers here in Oklahoma as well. But primarily, if they're located in our footprint, we have bankers in each location.
Okay.
Yeah. Little fun fact about Gonzo: his father is a contractor, owns a construction company in Chile,
yep.
And has developed some pretty significant buildings there. So, Cashin, I'd love to hear a little bit more about you. And Gonzo, why don't you introduce Cashin, because you asked to bring him on?
Yeah. Well, I've when you asked me about doing this, I felt like Cashin will be a great person to have in this podcast because, he has done SBA lending for 20 plus years. He leads our department here at BOK Financial. And I'm just, excited to work alongside with Cashin, and I think he has a lot of insights in the SBA world. But Cashin White is our director of innovation and growth for BOK, and one of his roles with that responsibility is leading our SBA department. So I'm excited to have Cashin. And Cashin, if you don't mind sharing a little bit about yourself, that'll be great.
Yeah, thanks, Gonzo. Yep, 20-year veteran in banking, stints in middle market, commercial, small business. But every bank I go to, they seem to have a hole in their business model that needs SBA lending. And they keep asking me, hey, we hear you know a little bit about SBA. Do you mind doing this? Do you mind doing that? So now I'm on my 4th SBA shop that I've helped build up. But yeah, I get the pleasure of working with great bankers like Gonzo. We've got about, in our commercial bank, 75 plus commercial bankers across our footprint, Colorado, Arizona, Texas, New Mexico, Kansas City, Oklahoma, obviously. So it's a really strong team. And then also, supporting our corporate middle market bankers on some of their sales enablement initiatives. So it's a fun role, but I've always liked it because it allows us to do a couple things that bankers aren't known for, and that's being creative and flexible. So always try and keep one foot in SBA lending.
I really like that. And over a 20-year career, I'm sure the SBA has changed quite a bit, and it continues to change today. Obviously, we had tons of changes during the pandemic, and now you told me right before we got on here that there's some big changes going into effect in 11 days at the beginning of August. So excited to hear about a little bit of that. I think for a lot of our listeners, many of them don't even know what the SBA is. So why don't we just start with the definition of what the SBA is and why it exists?
Yeah, I can start there, Khalil. That's a good question. And so SBA, really, it's a government agency that works alongside the banks that provide a percentage guarantee for banks, right? A lot of people think that they work with SBA directly to lend the money. Actually, they work directly with the bank. So in this case, we have a company looking for an SBA loan. They'll work directly with me, and we use the SBA product to have that guarantee, so that client can get the reasonable terms that they couldn't otherwise be available for them, right? And SBA, that's what it allows us to do. And they're different products, but simple terms, really, it's a product that commercial bankers and banks can use to mitigate risk and provide more reasonable terms to companies.
So does every bank offer the same thing? I mean, I know they're a preferred.
Yep.
Anyway.
So there's a. I'm glad you brought this point, Martin, because the first questions that I will encourage business owners to ask a bank if they're looking for an SBA loan is, are you a preferred SBA lender? And what really that means is SBA is giving a designation authority to the bank to make the final credit decisions. So all the underwriting, all the decisions really happen in-house. And different banks will have their credit appetite, what they specialize on, but there's SBA rules that they have to meet, and then there's a credit appetite that each bank will be more competitive, that they like. And another question, and Cashin, feel free to jump in here, is the bank more focused on cash flow, or is the bank more focused on collateral, right? Cash flow, the different appetites, and in our space is more of cash flow, right? We look at historical financial data to see if that business or that real estate they're buying can service the debt that they're for the loan, right? But that's pretty much the basics of it. Cashin, do you have any comments there?
Yeah, I think you did a good job, and you point out an important distinction. Excuse me. But anybody looking to talk to their bank or have a friend that's a banker, your first question you're going to want to ask is if they are a preferred lender with the SBA, which, as Gonzo said, that means that bank has the delegated authority to approve and originate loans, and so there's zero interaction with the actual government, which is important. If you're not, imagine going to the DMV to get a business loan. It would be a really, really horrible experience because you have to ship the file off to the SBA. They have to underwrite it. It just takes forever. So we've seen a lot of new entrants into SBA lending with all the SBA-related pandemic loan programs that came out. But it's important that you work with a bank that's not only preferred, but they have in-house expertise, a proven track record, a complete operations team. If it starts to get piecemealed, it really waters down the origination experience.
Yeah, very interesting. So we know what the SBA is now and that we can use it to get our loan. You mentioned creativity and flexibility earlier. And I'm sure that happens because the loan is guaranteed by the government. But what are some of the flexibilities and creativity that you're able to bring to the business owner that they wouldn't be able to get through a traditional loan?
Cashin, you want to take that one?
Yeah, sure. To simplify it, I like to say that it provides terms that otherwise wouldn't be available, that typically manifests itself in lower down payments and longer repayment terms.
Gotcha.
So better cash flow.
Yep, it helps improve cash flow, and it helps the business owner retain cash because they're not having to outlay as much for the down payment. And I think the underlying theory there, when they created the SBA back in the 50s, was, you got to remember, like, lending to businesses, especially small businesses, is still kind of a new idea for banks. It really wasn't something that they wanted to lend into until about the 90s. And that's where you saw the SBA really start to pick up and lean into their business model a little more, because they're like, gosh, we really need to dangle a bigger carrot to these banks to lend into what it was historically considered a higher risk demographic. And so the 75% guarantee or 50%, depending on the loan program that Gonzo alluded to, was a big push to help us, move into lending to this sector. And so it's a true win-win-win, right? So the bank gets to extend terms, and they can rely on the mitigant of that guarantee to help typically plug one or maybe two weaknesses in the credit profile. Meanwhile, the borrower gets a win because, again, they're retaining cash or getting better repayment terms. And then actually the government and the taxpayer gets a win as well, because right now, as it stands, none of the SBA loan programs are subsidized by taxpayers. The borrower pays a fee at origination. We pay a fee embedded into our interest rate into the SBA to keep it unsubsidized from taxpayers. It's actually accretive to the bottom line for the government, which is unheard of these days. And that's why you're seeing it really grow in popularity, and it enjoys bipartisan support. Both Democrats and Republicans look at it as a job creation program, and that's always going to get support in Congress.
Yeah, absolutely. Well, there's many reasons why people would get an SBA loan, and I want to walk through a lot of those. I know 3 of the biggest ones, or even 4 of the biggest ones that I can think of, are real estate, equipment purchases, working capital, and then acquisitions. So let's look at that first one, real estate, because I think most people are familiar with purchasing real estate, maybe in the form of a home. What does it look like on the SBA side if we're going to use that to buy a commercial building, a warehouse, a shop, whatever it is? What's the process like? How can we use it? What are some of the ways that we can use the SBA for real estate?
Yeah, SBA is a great product. And I want to clarify, when you say real estate, it's owner-occupied real estate, right? Meaning 51% and more has to be occupied by the operator, right? And that's how it falls under that bucket. So, and then on the owner-occupied real estate, there's 2 main products. It's the 7A and the 504. And the 7A, it's a one loan. You work with the bank to have that product. And basically the benefits is you can get up to 10-15% down payment requirements, 25-year amortization payment, and then no balloon payment. So going back to your question, Khalil, earlier about flexibility, well, I mean, as business owners, sometimes, you come across opportunities and maybe you don't have the cash really to buy that property or that building that you wanted to buy at that time, because, typically at conventional, we require you 20 or 25%. Then boom, then you can use SBA because today you only have 10-15% to take advantage of that investment as a business owner to buy that property. And you can buy an existing building, but you also can grown up construction. You can, hey, I want to find a land. I want to buy a piece of land and build a warehouse office to move my operations. That's a great product. And the 25-year amortization is a big deal too, because like Martin, like you said, cash flow, that will help them on a cash flow basis. And then the balloon payment, no balloon payment, it's also a big deal because on a conventional side, typically you will structure it where, it's a 10-year term and a 20-year amortization. Well, when they get to that year 10, they're going to have a balloon payment, and you have to refinance it, and you have to underwrite it, and to continue that 10-year note, right? Oh, in the SBA, you do it. It's a 25-year note, and then that's a big deal, right? That's a 7A, and then the 504, that's the other product that is very popular and very similar, and without going through all the details here right now, very similar, 10-15 down payment requirement, but you have two loans. 50% of the loan will be on the bank, and then a 40% loan will be with SBA. So the exposure of the bank will be only 50%. So sometimes, like if a borrower has a special use property, or maybe the bank doesn't really want to do the 90% loan to value, well, the 504 may be a good fit because they're only taking the risk on 50%, if that makes sense. But so
What would they be taking the risk on the 7A?
Well, the 7A will provide the guarantee. The 504, it will be a loan, just 50% with the bank and 40% with the SBA. So the risk really is only 50% if they have to liquidate the asset.
Right.
Yeah.
Okay.
Gotcha.
And just in passing, are this 25 years fixed? I'm smiling. Or what are the interest rates generally? You don't have to give a number right now, but how is it fixed, or is it something plus prime, prime plus something, or?
Yeah. So the terms, it will be depending on the bank, but typically it will be, you can go up to 15-year fixed. You have to be priced on Wall Street prime plus a spread, right? Cashin, correct me if I'm, go ahead.
Yeah, or minus. I mean, it's
Minus,
so
yeah.
The pricing on the, let's talk about 7A pricing. Gonzo's right. It is quoted as a spread to Wall Street Journal Prime. That is a requirement per SBA, assuming it's not fixed for the entire term. If it's fixed for 10, 15, or 25 years, then it's just whatever rate the bank quotes you based on their internal cost of funds. Otherwise, if there is a point where the rate will adjust, and you'll see most banks fix their rate on real estate for increments of 5, 7, 10, or 15 years. Now and then you'll see someone do 25-year fix, but it's going to be a much higher rate out the door. So it just depends on kind of where the borrower wants to come in. Obviously, the shorter the yield curve, the lower the rate. Well, that's historically the way it's been, but right now with this inverted yield curve, it's actually better to do a little bit longer fixed. We're seeing the most beneficial pricing today in that 7-year time frame. That seems to result in the lowest cost of funds for the lending institution, and that translates to a lower rate for the borrower. But historically, when it's a normalized yield curve, you could come out with maybe a 3-year fixed, at like 5% versus a 25-year fixed at 8%. So it just depends on where the yield curve's at any given point.
But you don't renegotiate the note, rewrite it, or amortize it, like make a balloon out of it, go again. You just change the rate.
When the variable rate period or the fixed rate period is over and it's time to fix it again for the remainder of the term, that is yes. Renegotiated at that time. But to Gonzo's point, it's not a new origination. It's just all right, you've had this rate fixed for 10 years. You hit your 10-year anniversary. Let's see where the debt capital markets are today, and we'll refix it for another 10 years at the prevailing spread to prime.
Gotcha. That's not a refinance. Okay.
And now the 504 is a little different. So the bank can price however they want, and that's going to be different from bank to bank. There are no rules per se on the bank's pricing. but the SBA, the 40% on the 504 is going to be a 20 or 25-year fixed rate note for the entire time. And that's typically going to be well below market as well. So that's why on paper, the 504 can look really attractive from an interest rate perspective for a borrower.
Very interesting.
Well, I've got two other quick questions. If you're building SBA, this will include a construction loan that converts to a fixed loan. I mean, you don't have to go get separate financing. They take the whole process all the way
Yeah,
through.
it will be a draw note. Basically, you are allowed to draw as you go until you complete it. Certificate of occupancy is done, and then we'll term it out at that time for that note that was approved. Yeah.
Okay. And then the last one is, what other criteria you're looking at? I mean, are you doing the whole cash flow? I mean, most of the places I'm thinking of would like to buy the building they're already occupying and paying rent on. And so there's some presumption of ability to pay there if they've been paying their rent. But you do look at credit score, their cash flow, their reserves, and their ability to put 10% down or 15 down.
Yeah. So I think if it's a rent replacement, that's a easy decision, right? Because you're really just taking out how much you're paying in rent versus what the loan is going to be. And if there's a difference, then you have to calculate that difference to see what the cash flow will be to pay that, right? But if, let's say it's an existing business and they already own a real estate, then it's an expansion, right? Then I'm adding the rent for that existing building plus the rent that they're going to be paying there for that new business. But yeah, primarily, Martin, is 2-3 years of historical cash flow. I got financials, tax returns, and I spread them the last 3 years and basically take all the net income plus depreciation plus the rent that's going away, and do they have enough cash flow to cover the pro forma debt of that SBA loan? And if they have plus in a room, every bank will have their own debt service coverage ratio, but ideally 1.2 and above, it's a good indication that that's a good owner-occupied real estate loan.
I want to ask one other question. We'll get on specifically,
Yeah.
but what's the quality of financials when you say I got to look back 3 years? You're smiling. What? I mean, do you routinely get financials that, holy cow, this looks great. I trust this. Man, they know how to add numbers and know what coverage is. Or is that what you usually see, or do you have to do some machinations and some explanations?
Yeah, I'll tell you, and Cashin, feel free to jump in here. I'm just going to speak on what I'm in my space, right? I mean, just to give you an idea, my typical clients are anywhere from the 5 million and 40 million, even more, 75 million revenue, right? So when you're on the higher end, those are quality, typically more quality. They have a CFO in place. And the quality of the financial reporting is just higher, right? Because the sophistication of the business is more, right? But typically in the SBA space, because, and Cashin, please correct me if I'm wrong, but typically is the 2 million in EBITDA and less is typically an SBA space, okay? And that typically some companies will have a good financial reporting. They don't necessarily have to have audited financial statements, but their quality is reviewed by a third party or something like that. Or if they're a little bit smaller, they have QuickBooks and they have their company prepare financial statements, and hopefully they're keeping up that. I know this is a topic that you guys talk about with your clients a lot, so I know that I want to dive into a little bit deeper, but ideally I want them to keep up, quarterly, right? If you can do it monthly, that's even better. But in the small business side, I probably say, hey, if you don't can keep up with quarterly financial reporting, it's an issue, right? It's already a weakness for you, and it's gonna put you in a harder spot to have access to capital, right? So I have a lot of times, Martin, where I get the 3 years financials, and we are now in August, and then I would like to see March, right? Well, hopefully I'd like to see 630 numbers, but some companies don't have that quickly access to reports and some of them may have to go back and, hey, can the CPA help us here and get those reports because we're applying for a loan? But that's the balance, right? Where, hey, how good are those financials? How quickly they can get to those reports, and then that's where the credit decision start taking place, right? Cashin, am I on the right track there?
Yeah, I think you did a good job. As you could tell from Gonzo's answer, it does depend, but the relationship we're building with the small business, one of the best ways you can show well to your lending institution is that you've got your stuff together, and that's going to manifest in the quality of your financials and the timeliness of it. I will say SBA does require all SBA lenders to first and foremost lend off of tax returns, and those tax returns are verified with the IRS to make sure what you're showing us is exactly what was filed with the IRS. But we always reconcile that back to either the internally prepared, the CPA reconciled, or the CPA audited financials to make sure everything makes sense.
I imagine that when that's all together, that's a significant time savings in the process of getting a loan.
Absolutely. Especially when we're going through economic times where things are changing rapidly. Right. I mean, if we could look at year-end 22 financials, that's great, and you could have a great year. But I mean, a lot's happened in the last 8 months, 6 months especially. So we're really focused on making sure 2023 has continued to show what most businesses are showing, which is a strong recovery from the pandemic. But we want to make sure 2022 wasn't just a blip and that you're able to continue those trends into 2023. And that's particularly important for contractors who are more susceptible to, large macro swings in the economy.
Right, for sure. I mean, what if you had to put a, rough estimate on the percentage of companies that are coming to you for an SBA loan that don't have the books in order, that don't have everything set up for you? And then how much time does that take you to be able to get that in order for them to get the SBA loan? Cashin, what do you think?
Yeah. Well, I would just say that it's, you got to be careful, right? You don't want to be, rude, right? We'll just take what we ask.
Sure.
We have a very succinct needs list, and we say, look, once you get me everything I need, then I'll start digging into it. But until you can satisfy that needs list, I'm going to move on to other borrowers that have everything ready.
Mm.
And so the clock doesn't really start until Gonzo and I feel like we have everything we need to have an internal conversation on moving forward with, a credit facility for the borrower. So it's more on the borrower, right?
And I think if I can add that to Khalil, and this obviously goes beyond the financial reporting, but this is not SBA lending. This is just banking in general. But character for us and banks in general, it's a big deal, right? So when borrowers come out and say, hey, look, we had a year last year that, you may see this in their financials. We still have, with looking for answers. So they kind of explaining that what happened and things like that. Everything that happened there is explained up front when they submit that package. Oh, that relationship is so much different, right? Because then it's a lot easier to go back and, I understand that they used to have a full-time controller in the office and they lost it because pandemic or something happened, and so they were having a hard time keep up with some of their financials. And just having that conversation up front with clients, it's a big deal, and then it makes the whole relationship and process smoother in that regard, for sure.
Hey, my last question regarding real estate, and then unless Khalil has some or you want to add, we'll move on to others. But does getting an SBA loan alter your existing credit facilities with other institutions? I mean, so long as you can meet the cash flow, but you don't want to say, hey, we're taking out your local bank and your operating line. And does it have an effect other than on cash flow?
You mean like if they get an SBA loan with an institution, they're limited to go and get a loan with a different institution? And
If that's one method, one way of thinking of it. But I'm also thinking I've already got a line of credit and it's drawn down, and I've got an operating loan, fixed, term operating loan. I'm cash flowing, But do you come in and want to take them out, or you're happy with that as long as the cash flow works?
Well, that'll be case by case basis, definitely. But the first thing that comes to mind is like if it's a working capital facility, and I don't know if that's where you go, Martin, but like typically banks want to have their operating accounts with the same institution, right? If it's real estate, then that's not always required. I mean, I think banks like when it's the whole relationship, but when I'm doing analysis, I'm including all their senior debt to get to my decision on cash flow, and then that will determine if I can do that SBA loan or not. As I don't know if I answered your question there or not, but
No, you did, but you're not going to come in and say, hey, if you want to do business with us, you got to give us those 3 loans too. Not automatically.
Cashin, unless you have a different view there, but that's not a per se requirement.
Yeah, Gonzo said it well. It's case by case. I mean, ideally, BOK Financial is a relationship bank. We're not transactional, so it's when we do look at lending to a new business, a new client to the bank, we will look at providing a full turnkey commercial banking relationship. It could be a la carte out the gate, where it's like, hey, I really like your proposal on your cash management and your line of credit features. But right now, I got 60 days to close on this real estate. Can we just focus in on that? And so we earn the right to win the rest of the business if we can execute effectively on the owner-occupied loan. Then we'll come back and talk about operating cash management, line of credit. But if the borrower out the gate is telling us they're unhappy with their current situation, we can move forward with multiple debt facility requests at once.
Okay.
Martin, I know that one thing you want to talk about was acquisitions, because you've got some clients that are, looking to maybe acquire some competitors in their area. Tell us a little bit about those clients and their situations, and then let's work through what that process would be like for them to use the SBA to get a loan for the acquisition.
Most of them are almost theoretical, but we're having conversations. One's manufacturing. I had a text last night, actually, at 5 o'clock. Former clients trying to buy a company. I don't know anything about it, the company. But my questions about doing acquisitions are, one of my main question is, how do you value the business that's being acquired, right? What down would the owner have to put up in order to do it? Do you take pro forma, do you accept cash flow estimates based on pro forma looking forward? Hey, when the two of us get together, I'm going to be able to do this, and this is where we go. Or does it have to be historic? And then how much, I'm throwing a lot into one question. How much down do the buyers, would they have to expect to have as a down payment? And then I've also heard that seller financed. In other words, if the seller agrees to take his money or her money over time, that can count toward the buyer's down payment. I don't know if that's true, but I've heard that. So that was a lot of things. Did you write them down, Gonzo? Because I don't remember what I said.
I'm going to take it in 3 tranches. So the first one, let's talk about how these are typically valued. So we called this segment of lending where SBA can play a meaningful role in a change of ownership. It's sort of Main Street lending. This is where private equity does not play, investment bankers don't play. It's too big for them. So it's called Main Street. And in Main Street lending, almost industry agnostic, there's a standard way that any business, it could be a car wash, it could be a dentist office, it could be a contractor, are valued. Now, there's subtle changes based on the industry, but in part, here's how it's done. They're going to look at the 3-year historical seller discretionary earnings. Seller discretionary earnings is defined as the EBITDA of the business plus the W-2 salary of all of the sellers and any other discretionary expenses that have been run through the business. That creates the seller discretionary earnings. So let's say a business has $700,000 in EBITDA. The sellers have been paying themselves $300,000 in W-2 salary. Seller discretionary earnings is $1 million. That million is then given what's called a market multiple. Market multiples in the Main Street lending arena are anywhere from 3 to 4x. Sometimes they can be higher or lower. So I'll give you an example of a CPA practice is going to have a smaller buyer pool because you have to be a CPA. So that's going to have a lower market multiple. But if it's something very simple to get into, maybe a restaurant where all you need is a license, it might have a higher multiple, but par for the course, we're seeing multiples sort of fall in that 3.5 range. So let's call it 3.5. So 3.5 multiple on the million in seller discretionary earnings would result in an enterprise value of roughly 3.5 million. Now you notice I didn't even mention the assets coming over in the purchase or anything like that. That does get considered, but ultimately the lender and the buyer are looking at purchasing a stream of cash flows. That's ultimately what they're buying. The assets that come along for the ride are nice, but they're assets that are needed to generate that stream of cash flow. So that's a really succinct way of doing it. There's always going to be nuances and carve-outs. But so when we look at it, we're obviously looking at the debt capacity, but we are required by SBA to order a third-party appraisal on the business being acquired. And those appraisals, that's typically the main methodology they use. They might have 3 or 4 methodologies in the appraisal, but it ultimately gets weighted more heavily on the market multiple being applied to the seller discretionary earnings.
Beautiful. So 2 questions. One, if the assets are worth more than 3.5 times seller discretionary earnings, then it's an asset. Somebody's just buying some trucks, right? I know of a circumstance where one company had $40 million worth of rolling stock, and the business was generating multiples of earnings was like a lot less. I don't remember exactly. So, okay, I'm not selling the bit. You get the business, I'll sell you the trucks for $40 million. And then that would be a different loan program probably.
Yeah, those are a little bit more nuanced and difficult. I mean, ultimately, there's going to be a maximum amount of debt that the business can handle from a SBA term loan point of view. And that's going to be one ceiling. The other ceiling is going to be the appraised value of the business to include all the rolling stock. So there might be a big gap. You might have an appraiser come back and say, look, this business is worth $5 million. And so the maximum loan amount per SBA, 90% would be 4.5 million. But the bank might say, well, that's great and all, but we're running our cash flow analysis. The maximum debt this business can handle is only 4 million. So now there's $1 million gap between value and leverage. But then you also have the situation where maybe there's an extra $1 million in rolling stock. So you could have maybe a $2 million gap in how much debt and the ultimate purchase price of the business. And that's where seller carry and equity comes into play to fill those gaps.
Okay.
And if I can add there, the seller carry bag is a great, I don't know if I call it like insurance, but great way to incentivize, if there was misrepresentation or something in those lines when, you're now the seller really has an incentive to make sure that the business, is successful, because otherwise they won't get that money back, right? So recommending and encouraging, like Cashin was saying, just being thoughtful on not over leveraging the balance sheet, but also that seller carry back can add a lot of value to make sure that, in the future that person is picking up the phone and, you have questions and talking to that seller if something comes in the future, right? So, and I want to share, now that we're in this topic, I wanted to share a statistic that I looked at before joining this. It's like, if you look at companies below 10 million in annual revenue, 47% of these companies are controlled by a founder that is 65 and older, and it's almost 50%. So there will be a lot of transition, and that's increasing now, right? But there will be a lot of transitioning happening now. Family-owned businesses, the son and daughter buying the business from, the founder, and SBA is a great product to meet that need. And anyway, I just thought it was a big number.
Oh, that's, yeah, the big wealth transfer. Cashin, you said that 90%, you used that number, which implies that the buyer's going to have to bring 10% to the table.
Yeah.
That was one of my questions there, is if you have holdouts on the seller, can that count toward any of that 10% that the buyer would have to bring to the table? That was, I heard that somewhere, and I was wondering if that's true.
Yeah, and I think it's better if I sort of step back and walk you through the 4 types of change of ownership loans you can do, because each is going to have a different down payment requirement. And I'll go through these quickly.
Okay.
But it'll be a good way to sort of break it down. So one are going to be individuals, or an individual looking to buy a business, and they're looking to buy 100% of it. So if you've got a contractor client, they're looking to sell, and they hire a business broker, that business broker takes it to market. They very well could have competing contractors or strategic looking to acquire them, or it could be somebody who's quitting their corporate job. Maybe they have a good background in construction, or they work tangentially to the construction industry, and they want to buy their own business. So in that situation, it's an individual buying a business, an outsider. There is a 10% down payment minimum requirement that SBA has, okay? I will tell you that, especially when it's a contractor being acquired, that's not going to do it for most banks. That's a really over-levered contractor, 90% acquisition debt. We're going to want to be talking to somebody who not only can afford SBA's minimum 10%, but has additional dry powder, maybe to bring the leverage down, or to just put day one capital on the balance sheet post-acquisition. So I encourage people listening to this to not get enamored with, oh, all I need is 10% down. Now, as of starting August 1st, SBA did introduce some nuances to seller debt that can play a role in the 10% down. So here are the rules. If the seller takes a note back and it's on full standby, which means no payments for 2 years, that seller debt can be counted towards the 10% down payment. So there is a universe that exists where somebody could buy a business with nothing out of pocket through that scenario, where the seller puts their debt on full standby for 2 years and the bank does a 90% loan to value SBA loan. That's probably going to be few and far between, and I would be careful if you're talking to a lender that would allow that. That's really irresponsible lending in my point of view. You're not going to be set up to win from a balance sheet point of view. And I doubt you're going to see lenders, especially in the economy we're in right now, looking to do 100% financing on change of ownership. It's the riskiest lending a bank can do. But it's out there. The other rule that they rolled out is if the seller carry is on interest only and the buyer's bringing at least 25% of the required 10% down, so really they just need 2.5% down, and the business can debt service the interest payments on the seller carry note, then yes, you could do ostensibly 97.2 or 97.5% loan to value with the seller carry. But again, I'm not really sure why SBA did that. They have changed their down payment rules on business acquisition several times over the years. It used to be 25% required, then back up to 10%, then they were silent on it. Right now, I think most lenders are moving into a universe where we're just comfortable with 10% down minimum. And we're not really going to mess with that seller carry nuance. So that's a business acquisition. There's also strategic acquisition. That's where an existing contractor is buying another contractor. And if those contractors share the same NAICS code, 6-digit NAICS code, and they're in the same geographical area, SBA doesn't consider that a business acquisition. They consider it an expansion. And in those situations, the down payment rules go out the window. And what instead we're encouraged to do as lenders is look at what the combined, and by the way, I see you taking a lot of notes, Martin. I do have a side-by-side guide that breaks all 4 of these out really clearly. to help you because it is complicated. So if it's a strategic acquisition,
Well, I'm not going to explain a lot of this to people. I guarantee you, I'll put them in touch with you guys.
no problem.
But it's for me.
in those situations where it's a contractor buying a contractor, we're going to want to look at the combined pro forma balance sheet and obviously the debt capacity repayment of the newly combined entity, just to make sure that it makes sense. And if it does, then we could possibly do 100% financing. We've done a few of those in a few situations, especially if the buying entity is really strong financially. Otherwise, if it looks like on a pro forma basis, it's going to be a little over levered or there's too much debt for the business to cash flow, we still reserve the right to ask for an equity injection or a down payment. So that's strategic acquisition.
Yeah.
The third type is called a partner buyout. And this is where there may be 2 or 3 or multiple owners. And let's say it's a father-son. The son is ready to buy out the father. They own it 50-50. We can do a loan for just the purchase of the father's 50%. And in those situations, if the buyer has had 10% or more ownership in the business for the past 24 months with the same level of activity in the business as a manager, then they can qualify with possibly 0 down. But there's also some financial hurdles the SBA layered in. For example, the debt to net worth ratio on the balance sheet historically and on a pro forma basis needs to be below 9-to-1. And if all those conditions are met, then you can do 0% down. Otherwise, a minimum 10% down payment will be required.
I feel like those last two, Cashin, are probably what our audience would be the most interested in. I don't know that a lot of our audience is looking to buy or acquire businesses that are outside of, what they're currently doing typically. And there are definitely cases that I can think of where individuals that listen to this podcast would do a buyout with a partner, or they would do a strategic acquisition. And I think that a lot of people that are, in our target audience, they think about growth for their company, and they're always thinking about, okay, how can I maybe run some ads or hire a salesperson, maybe add a new service that will expand our offering to our customers. But growth by acquisition is a really good means if they're doing that strategic acquisition like you talked about, and they may be able to do that in a fashion that's completely financed by the SBA. So very interesting to hear that side of it.
When that's exactly what we're seeing in our loan pipeline, it's almost, especially for contractors, it's strategics. They catch wind that one of their competitors is for sale, and they're like, oh, this would be a great opportunity to consolidate, or there's a partner buyout. That's the majority of our business acquisition pipeline right now. Mm-hmm. But August 1st, SBA is rolling out a brand new change of ownership, which I think is going to be extremely popular. And this is called a partial buyout. This is where a business can sell a portion of their company, but not all of it. So the other 3 that I mentioned, the seller has to sell 100%. And the seller cannot stay on as an employee. It's a full change of ownership. They can stay on for a year as an independent contractor to help with the transition, but they can't hold a meaningful role. They have to sell 100%. They got to walk away. Partial buyout introduces a new paradigm to SBA lending that's never existed, where a seller can sell a portion of their business to a buyer.
I'm sorry to interrupt you, Cashin. Is this the 4th type?
This is the 4th type. So you have business acquisition, where individual buying a business, strategic acquisition, like-kind business buying each other, partner buyout, and the 4th is partial buyout. So this is an outsider coming into the business and saying, I want to buy it. So here's where we think this is going to work the most. You've got a contractor, maybe an absentee owner, built it up over 20, 30 years, and just has a great general manager or COO that's been sort of running the business for the last 10 years. And they want to sell to that person because they know that person knows the business the best, is most likely to keep all the employees, understands all the relationships with all the prime contractors and all the subs, and they know it's going to be the least disruptive to their business. The problem is that person probably hasn't accumulated, a large enough cash reserve to afford the minimum down payment of 10 or 20% or whatever the bank might require. In this scenario, a non-owner buying in can maybe buy 20, 30% of the business, and in certain situations with 0 out of pocket. so long as the financials of the business show that they can absorb it from a leverage and a cash flow point of view. So this way, they sort of get to buy in a little bit, make sure it works well, being owner, co-owner, and then after a couple of years, they can come back and purchase the remaining percentage ownership through a partner buyout loan. So this is very common. We see businesses wanting to sell to key employees all the time, but the key employees just can't afford the 10% down. We're excited to see what this looks like. One thing that I think sellers will have to get mentally prepared for is they will most likely be asked to be a co-borrower or guarantor on the debt that the buyer is going to use to buy a portion of their business. So we'll see how that plays out mentally in the minds of sellers, but that's a new program rolling out August 1st.
Global question for all of these that I forgot. Personal guarantees required on everything?
Yes. Yeah.
Yep.
Real estate?
20%
Everything we talked.
ownership
Okay.
and more, personal guarantee included. Yep.
Does that include your house? I know people wonder that. Does that include a home or is a house
Yes.
exempt?
Mhm.
It does include a house.
Yeah.
Include
Okay.
the house.
Yeah, the
Wow.
rule there, Martin, on homes being pledged to the collateral pool is after the lender's taken all available assets as collateral, so that's going to be a UCC filing on all business assets. If there's still a collateral shortfall, which 99% of the time there is on a change of ownership, because again, they're buying a stream of cash flows, they're buying goodwill. That's not a tangible asset. SBA and banks consider tangible assets to be real estate, equipment, furnitures and fixtures, AR and inventory, but those are so heavily discounted in our collateral analysis that there's always a gap. So then SBA says, okay, lender, if there's a gap in loan amount and collateral, we ask you to pursue additional collateral if it's available. If it's not, that's fine. You don't have to decline the loan, but at least look for it. And what they ask us to do is say, hey, look at the buyer's personal financial statement and see if they have 25% or more equity in their home or any rental properties. If they do, and there's a collateral shortfall, we are required to take a second deed of trust on their homes or rentals until either the collateral shortfall is zero or we've taken all available collateral. But that is something buyers need to be mentally prepared for. That you're all in when you do a change of ownership transaction. Personal guarantee, usually putting your home on the line, large cash infusion. There's really no way of getting around that unless you live in Texas. You can't pledge your home towards a business loan if you live in Texas. So they get a special little carve out.
Nice.
Okay. Thank
Well,
you guys.
I want to hear more about the working capital aspect, and just how the SBA gets involved from that standpoint and how it changes things for a small business.
Yeah, I can talk a little bit about that, Khalil. Before there's definitely SBA products for working capital, and we use express lines that can go up to 500,000, and those are primarily to meet short-term needs. And then if you get closer to $1 million and above, then there's other products, that are called like cap line, governed by borrowing base, receivables, and for that. But when companies start inquiring about working capital needs, we always like to ask a few questions just to kind of understand what's the main reason behind the working capital need, right? So like, hey, what's your working capital cycle looks like? And especially in this environment, I mean, just the lines of credit just almost doubled within the last 18 months in interest rate. And so the cost of capital for, companies, really, it's been a topic. And so that when we're talking about with clients these days, it's just how can they be more strategic on their payment, right? How they're paying their vendors right now, how they're receiving payments, right? And is there opportunities to maybe save them a day or two, and then so they can, at the end of the day, I have conversations where they thought they needed a working capital line, and then when we start working backwards on what are their internal processes, how they invoicing, how they're getting paid. And then, especially in this day, even if you talk to your vendors and say, hey, if I pay you with corporate card today, so you get cash today, would you give me a discount, a 1% discount? And maybe they've done that like 18 months ago, but in this environment, that vendor is going to think about it because now they are tapping into a line that's maybe a high interest rate that they may be willing to take that discount, right? So just that's the basic when we have conversations on working capital, and you'll be surprised. I mean, 1 day savings, I mean, you guys know this, could make a huge difference in the working capital for a company. And of course, there's a time where like manufacturing companies and companies that really need that working capital line, then the SBA is a great product as well. Because like I mentioned, the express line, 500,000, and then when you go up on the higher end cap line, it's the other product that it can be used for working capital. Cashin, is there anything else that I missed there? Sorry, Martin.
I was just going to say, I'm going to take the opportunity again that what you're talking about maybe is inventory turns and day sales outstanding, and getting a discount from your supplier, or at least paying them on 30, not paying them on 15 days. You find all that stuff out in your books.
Yeah.
You're not going to know what your day sales outstanding, how long it takes you on average to collect your receivables if you don't have good books. That stuff very few people think about. But I did an example for a guy the other day, and if he could reduce his days sales outstanding, in other words, the days it took to collect his receivables, he would free up $54,000. This was his business of a certain size. He would free up $54,000 of cash. Hey, what do you mean? I mean, go collect your accounts receivable and pay your payables on the term. Don't, unless there's a discount or something. Anyway, sorry, I just plug in good books.
And the reason why I'm sharing that goes beyond the SBA, because I know you guys, coach your clients and that perspective. So I think we take the same approach. I mean, we take the consultative approach and kind of understanding, what's the working capital cycle looks like, and understanding that. And then we lay out the options. Yes, SBA could be an option. Maybe it's a conventional option. I mean, it doesn't have to be SBA. But I mean, that's before we get. I want to say this too, because Gonzo's on here, but I make this point frequently. If you have a good banker and your banker is willing to tell you the criteria on which they evaluate you, go find out how they do that. Because you have a common interest. The bank wants you to survive and pay them back, and you want to survive because it's your business, right? So you may think they're jerks because you don't understand this or that. Well, go find out. And there was something else I say, if they won't tell you, then find another bank. So sorry, guys, you will tell them, right? So, Yeah. And
Khalil, back to your question.
I don't know, Khalil, did I answer your question on working capital space?
Yeah, for sure. I think so. And I think it's, obvious to a lot of people that they need working capital, and that they a lot of times are not collecting their payments on time, or they're having to pay things down to get a lot of inventory in hand. And I think that it's a no-brainer to go for the working capital at least. And I think it makes a good point, Martin, that we talk about all the time, is really you should be talking to your banker before you need them. You should start the process of having a relationship with the banker and even understanding SBA programs and looking into the future, because a lot of times when you need these things is not the right time to be providing your financials. And you're going to have a worse rate, and you're going to be in a time crunch, and there's more stress involved, and you don't want to have to jump through all the hurdles when it's too late. You want to be able to have that relationship, understand what opportunities are out there well in advance. That's.
And I can add there too especially we were talking about acquisitions, but like when you're looking at that acquisition opportunity, like I will be asking your banker, it's like, hey, am I buying a business? Let's say it's $1 million business today and revenue, 10 employees, right? And then they say, you know what? I want to buy this business and I want to keep it to this size. Well, actually in 5 years or 10 years, I want to take this to a $20 million, $30 million company, right? And just asking your banker, like, hey, what resources do you guys have to help me with that growth. Because typically, they're just so focused on the interest rate today, on the transaction. But if they have that clear plan, like, man, in 5-10 years, this bank can, man, who knows, can help me. I'm going to need 401ks, insurance needs. I'm going to need more comprehensive financial institution to help me for that growth. Then those questions should be asked like early in the process, right? And I don't know, would you agree, Cashin?
Yeah, absolutely. Working capital. Oh man, there's so many different ways to interpret it. I really like all the tools on your website. That's really cool. Because contractor working capital is scrutinized more heavily than other businesses because it's the lifeblood of the business. So to Gonzo's point, not only do you want to be talking if you know it's going to be an SBA loan and a bank that's good at SBA lending, you also want to make sure they're a bank that understands contractor lending. Because what you don't want to do is get into a situation where they're like, oh yeah, well, you cash flow, here's your $500,000 line of credit, good luck. But then you start to grow and your receivables, inventory all becomes a lot more complicated and they don't have the acumen to grow with you. It's going to be very frustrating because you're going to have to go sit with a new bank, maybe 3 banks, retell your story, asking for a larger line, all while you're juggling your business. So attaching your, wagon to the right horse early on, if growth is your goal, is very important.
Yeah, absolutely. Well, I'd love to, how can people get in touch with you about SBA programs like we've talked about today?
Well, I'm in LinkedIn, so I'm actively there. Gonzo Garzon. I mean, people can find me there, and I also have my email. That's ggarzon@bokf.com. And look, I always say that whether they need an SBA loan today or they're thinking about it, I'm always happy to just have a conversation. Doesn't matter if it's too early or it's a right now thing. Like I said earlier in my conversations, I'm always enjoy hanging out with business owners and entrepreneurs. So that's my deal.
Can you list your states again? We have more listeners outside of Oklahoma than in. And you mentioned, I don't know if you mentioned 10, Cashin, but you said some of them.
Yeah. We're in Texas. We're at Colorado, Oklahoma. That's our headquarters. We have New Mexico. Help me out, Cashin. I'm going Arizona.
Arizona and Kansas City.
Yep.
Are our main hubs. We also have offices in Arkansas.
Yep.
That's where our production, commercial, and corporate bankers sit. The 10-state footprint, we have other services like wealth management, some of our securities units, but for the core banking that would fit your demographic, it's going to be the Texas, Oklahoma, Arizona, Colorado, New Mexico, Kansas City.
Okay, excellent. And Cashin, how can people get in touch with you?
Through Gonzo. So
there you go.
Yeah, we're very fortunate that we have awesome bankers. We don't like to parcel out our SBA lending, so you get to work with a really good banker, and I'm behind the scenes making sure everyone follows the rules. I spend most of my time from SBA point of view, reaching out to individuals like yourselves to help educate the business community on how SBA works, breaking down some of the myths. But as far as the core banking goes, you get to deal with people like Gonzo.
Excellent. Well, we'll put your contact information, Gonzo, in the show notes. We really appreciate your time and the education that you bring to our audience. And we hope that people will get in touch with you about the SBA and other banking needs as well. So yeah, thank you both for your time today.
Thank you, guys. We really appreciate it.
Thank you.
Yeah.
Thanks for listening to The Cashflow Contractor. Check out our website in the show notes or visit thecashflowcontractor.com.